Hi there everyone, Andy Cassidy, Cassidy & Associates Real Estate. Stock market or real estate, which one is a better investment for you? Before getting into real estate or stocks, you need to understand investing is a personal choice with no right or wrong answers. Many investors have found success with both the real estate and the stock market. But before investing your money, understand your risk tolerance, your goals, and your investment style. Ask yourself, how risky are you willing to be? Are you okay with a 10, 20, 30% loss? Make sure you understand your financial goal. Make sure you know your short and long-term goals, as this will affect your investing strategy, and understand if you're looking for more of a long and steady path or a short and fast, risky type of investment. Once you understand yourself financially and where you want to be in the future, you're ready to decide if real estate or stock is the way for you. Don't use this video as your investing guide. Do your own research, talk to your own legal and financial team, and we'll get into stocks. Before investing into a stock, we need to understand what a stock is. So a common definition of a stock is a type of security that signifies proportionate ownership in the issuing corporation. This entitles the stockholder to that portion of the corporation's assets and earnings. So put simply, a stock is just a piece of ownership into a corporation. And generally you can get paid out two ways. As the company's value increases, your share price goes up. And the second is a dividend payout. So a dividend payout is when a company will give you a cash payout either annually, monthly, or quarterly just for owning their stock. Just like any investment, there will be a certain amount of risk. A good example is the recent COVID-19 epidemic. We saw stocks at nearly an all-time high, and then they went down dramatically and are starting to recover. Share prices are affected by geopolitical and company-specific events. With this being said, investors try and diminish their risk by diversifying. So diversifying is spreading your assets through different market sectors. You don't want to keep all your eggs in one basket and keep it all into one sector, because if that one sector falls, your money is gone. Another great benefit to stocks is that it is passive. So passive means that it requires minimal or no work, which is coveted by a lot of investors. With this being said, it allows you to have a day job or just do what you want throughout the day, as you don't have to be active and go pursue with your stocks. When it comes to a return on investment with stocks, we'll be looking at the S&P 500. The S&P 500 is a culmination of the 500 largest stocks in the US. So on average, since 1957, the S&P has returned about 7 or 8% per year. With this being said, it doesn't mean every single year in a row it's 7 or 8%, but in a culmination of many years, it turns out that the average of each year is 7 to 8%. So here's a good example for stocks. In 1973, if someone were to put $10,000 in their account, then it would have dropped to $5,500 because there was a big crash. If they would have left that money in that account 12 years ago, it would have been worth nearly $300,000. And if the same exact scenario, if it were put in a bank account rather than a stock account, 12 years ago, it'd be worth nearly $41,000. Now transitioning out of stocks, we're going to be comparing to real estate. A real estate investor looks for two factors when they go to get real estate. The first one is cash flow, to see if the rents collected will be positive. The second is appreciation of the property. And appreciation is the increase in value of that property. For some, a common reason why they shy away from real estate is the barrier of entry. And what I mean by this is that for some, it's just too expensive to get started. Don't worry, I'll be creating an upcoming video showing you some methods of how to pierce this barrier of entry. When comparing the passive side of stocks, it doesn't translate to real estate. Real estate is a lot more active and it requires a lot of maintenance. For example, you have roofing, plumbing, foundation, carpets, painting. I can just keep going on. And also there's a vacancy factor. And so for vacancy, you're gonna need to find yourself a tenant. I'll put a link in the top right of this video that you can click on, and we'll go over my video of how to find a quality tenant. Now getting into the return on investment for real estate, according to Investopedia, The average for long-term residential real estate is 10%. This doesn't mean every year your property will go up 10%, but over a culmination of many years, the average year is about 10%. And once again, there are no guarantees for the future. With all the facts presented to you, we did not go over the advantages and disadvantages when it comes to tax with stocks and real estate. Make sure you always consult your legal and financial team before making any investments. Real estate or stocks, the choice is up to you. Thank you guys for watching. With all the facts presented to you, make sure to comment below which one you prefer, stock or real estate investing. We're posting videos every Tuesday and Saturday. Make sure to like and subscribe, and we will see you in the next one.